Jason Adler, I'm really excited to have. Gotham Green has recently deployed over $40 million in North America. And Jason also serves as an independent director of the Kronos Group, which recently received the Altria investment, and who we had their CEO here a couple months ago as well. We also have Sean Stifel, who's a portfolio manager at Navy Capital. He founded it in 2014, and he manages their Green Fund, which is the first U.S.-based long-short public equity fund dedicated to cannabis investing. And Karen Wadera is the managing director of Casa Verde Capital, who I'm sure you've heard of, invested in a wide range of businesses based here in LA. He spent over a decade in Asia as a senior executive at Goldman Sachs and Nomura. Margaret Shanley is a principal at the law firm Cohn Resnick, and she leads their national transactional advisory services practice, and really focuses on helping strategic and financial buyers and lenders in the performance of financial and business due diligence on platform, add-on acquisitions, and carve-out transactions. And lastly, we have Barry Weiss, who will be moderating. He's a partner at Thompson Coburn. He serves as the corporate strategist and outside general counsel to a wide range of small and mid-sized companies, and he's the managing partner of their LA office, and he's also one of the founders of the firm's cannabis practice. Really impressive panel. Take it away.
Thank you all, and it's a pleasure to be here. One correction is Margaret works for Cohen Resnick, and they're an accounting firm, not a law firm.
Oh. Sorry.
No worries. So our topic is investing, and we've got basically three things that we were planning on covering: what and how to invest, whether it touches the plant or not, how to analyze possible investments, and looking into the future. We've also want to take questions from the audience, so there will be a roving mic, and toward the end of the presentation or our discussion, that mic will be available. So if you do have a question, please raise your hand or find the microphone, because we'd like to answer the questions that you as investors may have. So the first topic that I would like to raise to the panel is what and how to invest. There are investment opportunities in the public markets, in funds, there are investment opportunities in REITs, there are opportunities in businesses that touch the plant themselves, and also ones that are what are called marijuana-related businesses that do plants, equipment, that do equipment or real estate, things of that sort. And so let me open up to the panel in terms of what are the better investments in terms of being in a plant or not, or going to the public markets or private markets or REITs of that sort. Want to take it away?
I'll kick it off. Sean Stiefel from Navy Capital. I think for us, we're always looking for the best risk return. Net, it doesn't matter if it's public or private, and what you've actually seen at the start of 2019 was a pretty compelling public market after sort of the death spiral that existed after legalization on October 17th. So we're pretty agnostic, private versus public. We generally believe the most inefficient market is the tip of the spear that touches the plant. And so that's really what we think is where we can create an arbitrage. At the end of the day, my background is I was a trader, and I think the most inefficient market is where you really want to operate in, because you have an edge there. And so private versus public, we're agnostic. Generally speaking, we try to go after the tip of the spear, which is plant touching companies.
Sean? Jason, I'm sorry.
So I'll just get to the second part of your question. I think you can make money in any vertical because it's early enough. So there are things we generally avoid, like cultivation as a standalone. It's not that interesting to us, but anything else, really, it's about management. It's a human talent game. If guys are ethical, focused, have a good management, have a good plan to run their company, I think we can step in, help them get from point A to point B, no matter what vertical it's in, whether it's public or private, et cetera.
Because there has been, last year, the investment in cannabis was the same as it had been over the last 5 years in totality. So there's obviously a lot of money coming into the market. Do you think there's a greater risk in terms of companies that touch the plant as opposed to those who do not?
Well, there's a greater perceived risk by institutional investors that aren't willing to touch the plant in the U.S., which gives us here, I think everyone, our opportunity set to do this before that money rolls in. But I don't think there's a real risk.
And if I could comment, Barry, my job every day is to diligence companies on behalf of our clients who are investing in the space. And what I've noticed is definitely there seems to be a propensity to lean towards the ancillary or non-touching businesses. Everybody thinks that's where the easy money is to be made, so to speak. And they're not subject to the same restrictions, the 280, et cetera. So certainly there's less perceived risk there. But I do think the cultivators I've worked with, the background checks are very important. They're horticulturists by background. They really have very strong production operational backgrounds. They know where the efficiencies are, and those ones are doing pretty well. But they're also large scale, I would say. I've just worked on a $1 million square foot facility, and that's going to be a survivor. There's several others under 50,000 that won't be here.
Right. Corinne, do you want to add something?
No, I mean, I agree with the panel. I think you have to look at it in two ways, right? Are you investing? What's your time horizon? Or are you trading, right? And basically, you can make money in many ways. There's a great tide that is, sort of behind us here in cannabis. So the opportunity to make money is multifold in many industries. Casa Verde in our fund is focused specifically on the ancillary opportunities, and that has never really had anything to do with the legal ramifications, much more around scalability with low capital intensity, right? As was just sort of discussed around a 1 million square foot facility, that's very capital intensive, a lot of equipment, licenses cost a lot of money, real estate, et cetera, et cetera. What we've found in a lot of our ancillary plays is that, you don't need the sort of same capital intensity. You can scale without licenses, and so that's why for our first fund, that's where we've focused a lot of our attention.
Right. I know for us, we have a lot of clients who have gone into or been asking us about cannabis-related industries. We just recently had a client who was in the armored car business and was asked to transport, not product, just the cash. And we actually rewrote a bunch of contracts for them last month, and one of the issues was insurance, as if that armored car was held up, would the insurance company cover the money that was designated from the cannabis facility? So there are a lot of ancillary issues that sometimes will affect businesses in not necessarily in the plant touching business, but in the kind of the related businesses. Is there any investment in a business that you think will produce a far greater reward than something else? And there's growing, there's extraction, there's distribution, there's dispensaries, then there's obviously the real estate REITs, which are real estate investment trusts, which buy the real estate, then lease it back, don't really get into the business. Companies that are producing equipment specifically for cannabis, within kind of that gambit of businesses that do different, perform different functions. Is there one or more that you think is either more likely to produce a greater return or reward, or conversely, is more difficult?
I think for us, we're really focused on brands and distribution. We think ultimately, like any CPG, that's what determines the winners, and that's where the juice is. At the end of the day, what we're playing for is the fact that a lot of marijuana is going to be consumed across the globe, and who's going to actually be selling that marijuana is really where we think the ramp is. If you look at kind of global legal sales in 2018, the number was between 18 and 20 billion. We believe that number ultimately looks closer to $1 trillion. And so the guys that are really going to capture that are going to be the brands and distributions, which we think from here have the most upside. Obviously, any specific individual investment could have its own risk return, but generally speaking, from here, we think brands and distribution, and like Jason said, not cultivation, is where the real juice is going to be.
Jason?
I would just add to that list IP, technology, anything really scalable and defensible, things that we look at.
And from my point of view, because my background is real estate, I think real estate has been a very positive place. Most of the cannabis-related companies, whether they're growing or doing extraction or anything else, are in industrial warehouse type space. And at least the deals that I've been participating in Los Angeles, while we do work across the country, the rents are significantly higher. They are about double what they are for any other use, manufacturing, for example. And one of the arguments that gets used is that there is a risk of forfeiture by the federal government. Therefore, there should be a premium on the rents, and investing in real estate, again, it's got to be in a green zone. There's a lot of restrictions to finding the right piece of real property, but if you can find the right piece of real property, there's a higher rent, a higher rate of return to be garnered by it, and if for some reason the business fails, you still have presumably a good piece of property that you can repurpose for something else. So I think real estate is another area that has some very good returns and possibilities to it.
Yeah, I would agree, Barry. I think there's a very interesting public REIT called Innovative Industrial Holdings. Went public in 2017, and it's just interesting if you follow them in terms of their characteristics. You know, they've provided their shareholders with the distribution, a dividend for the last 6 quarters on a consistent basis, and it's increasing. They've doubled their portfolio. They just bought a huge amount of property in Illinois, so their asset base is really good. They build in fairly consistent increases in their rents into their sale-leaseback agreements, and they have management fees. And they've just raised a substantial amount of capital, so that's going to help them, grow forward. So I think those are, at least as we work with our REIT clients, both certainly the public ones, those are important characteristics.
And obviously, it was mentioned before on one of the earlier panels that some of the Canadian stocks have taken a beating recently. You guys have any thoughts of the public market and that in terms of an investment?
I think at a high level, the stocks across the board, Canada and the U.S., got pretty beaten pretty badly from October to December. For us, holistically speaking, I think the Canadian advantage of being a first mover on the recreational front is not nearly as important as the market ascribes, given that there's still a valuation premium for Canadian assets versus U.S. assets, even though holistically kind of what we're seeing, and obviously Jason knows more than I do, you're not seeing huge international revenue, which is a huge part of the Canadian bull case. And so for us to look at these valuation disparities and say, you should pay a premium multiple for Canada, when in fact there really is not the first mover advantage that we're seeing. Obviously there's exceptions when an Altria deal happens or a Constellation deal happens and companies are flooded with cash, but holistically, if you take out the companies that have the multinational deals, there's still a valuation premium to U.S. assets, which to me makes absolutely no sense in the context of California's 40 million people, which is about 30% bigger than all of Canada, which makes it a much more enticing rec market just in the state of California. So I think when we look at valuations, we like going long the U.S. names versus the non-sort of multinational deal guys, i.e. Kronos and Canopy, but all the other Canadian names to us, the valuations don't make a ton of sense relative to what you can be buying in the United States.
Anybody else?
I mean, I'm glad to opine here. The market just needs to figure out the difference between the winners and the losers. Like, the one thing about Canada for the winners that are going to be up there in TBD are that they're building platforms up there, right? And no one in the U.S. has really built, well, I can't say no one, but the platforms up there, they're in a single spot, they're very efficient, or they could be, and these things have tentacles and they could be in the U.S. and everywhere else in the world. So the value of that platform on a go-forward basis, if it's executed correctly, run correctly, it could be bigger than anything. That's maybe where the Amazons of cannabis are going to come from. But other than that, I agree with them.
Yeah, and last year in 2018, 57 U.S. companies were acquired by Canadian companies, and it was 24 the year before. In the U.S., the SEC really doesn't have a problem with listing cannabis companies. Just in your disclosure, it's got to say, this cannabis company. The problem is on NASDAQ and the New York Stock Exchange, because cannabis is still a Schedule I drug. It violates federal law. In Canada, that is not a problem, and one of the things we'll talk about at the end is what we think the future will hold. But that kind of leads into the next topic, which is analyzing a possible investment. Some of the Canadian companies have sold in excess of 300 times earnings, and for companies in California, and as one of the earlier panels discussed, California is the 5th largest economy in the world, and the California cannabis industry is as big as Canada. But most of the cannabis companies do not have a long track record. I'm a merger and acquisition lawyer, mainly in healthcare and transportation technology, and most deals are a function of a multiple of earnings, EBITDA. So my question for the panel, let me start with Margaret, is how do you evaluate a company? What do you do about 280E, because you can't deduct all the expenses? And how should somebody analyze an investment into a cannabis company?
With optimistic caution is what I would say to start off with. I find there's a wide variety of, quality of management teams, governance, best practices, controls. You go from working on maybe a cultivator that, can't open a bank account. You go in there, you're trying to verify revenues and cash flows, and it's like, maybe I should just go into the safe and count it, right? Because there are no records. So it takes a lot of, I would say, resourcefulness. You have to really, it's almost what's not there. You have to kind of find the ancillary systems. If it's not reported in your financials, let me go and just verify the cash inflows and outflows as an example. But we start off with, really understanding the background of the management team is very important. What's their pedigree? What have they done in the space? Are they horticulturists if they're, cultivators? Have they CPG backgrounds if they're, on the ancillary side? Because I think that's really important. I think we've heard a lot today about branding already and the ongoing importance of it. At the end of the day, in the plant touching, I think free cash flow is a huge driver. I mean, Karen just said, he doesn't invest in those kinds of companies because of the capital intensity of them. But at the same time, if you have that scale, if you have access to capital, you can do very well. But you clearly free cash flow drives. You have to understand the free cash flows and what the capex requirements are. For the ancillary side, it's like any normal operating company. You should, you're not subject to those restrictions, and we like to see earnings. Some of them, some of the companies we're working right now have, been established in the last year or two, but they've got a strategy, they've got a business model. We look at their projections, we look at the earnings going forward as much as we are looking at the past, and it's really understanding, have you good systems around reporting your revenues and expenses? Have you got a good handle on your balance sheet? Have you got a good finance team that's able to help you, do quality reporting on a monthly basis? And really, what's the governance of your company? Have you got a good advisors, a board of directors who really set the tone at the top? I mean, that's become increasingly very important, and not all companies obviously have that right now, but I think the ones that will survive are building it now and putting those systems and procedures in place.
Jason, you're shaking your head.
Well, no, I agree with her. I was just thinking that we're kind of in a fortunate position, just Gotham Green is, because we've built an ecosystem of sorts where we have companies, portfolio companies who are partners, right? We work very closely with them in every vertical. So we can look at companies differently than someone else can, right? So maybe someone in this audience would look at a company and say, all right, what does this company look like in 1 year, 3 years, 5 years? They have all these things in place, but we can look at it with our ecosystem and say, hey, how does this fit in? How can our ecosystem help this company? How can what we do help this company get to where they go? So, pricing is in our favor. They want to work with us. We can help them out. Everything's got hair on it, which makes this actually like fun and exciting and really profitable. So, you're totally correct. But we get to look at things a little differently as well.
Because you have those synergies across the portfolio, yeah.
Karen?
Look, we're in one of the fastest growing industries in the world, right? And with that, and with speed and explosive growth comes a lot of issues. So for us, we like to get involved I mean, we're fairly stage agnostic, but we tend to get involved very early. The most important thing for us is a shared vision, right? I think that's where, as investors working with companies, you can have the most conflict. If we're not in sync as to what it is we're looking to do next month, next year, and the next 3 years, this is not going to be a fruitful relationship. And as sort of Jason alluded to earlier, we sit on a ton of insights, right? We have 15 companies in all different areas of the ecosystem, whether it's from staffing to compliance to direct to consumer to lab testing, et cetera. So we get to understand businesses, I think, a lot better than someone who doesn't have that kind of exposure, right? We're super proactive investors. We're, on the boards of the majority of our businesses. So we get, I think, a deeper insight and look as to how the industry is shaping in a way that others may not. So look, there's 101s to investing, and, you can try to put barriers and ranges on what you want to pay for multiples of revenue or EBITDA, if there is any, or where you think things are going, et cetera. But at the end of the day, especially where we come in, and given that the industry is being shaped as we sit here, the most important thing for us is that the entrepreneur is, very much in step, in line with where we are. And if they're not, it can still be an amazing business. You can still make a lot of money, but, it may not be a sort of worthwhile sort of investment for us.
Sean?
For us, we want killers at the end of the day. We want people who realize that there is a massive secular tailwind behind everybody here, and this is a huge market, and we want CEOs and management teams who lose sleep over the fact that there is so much to do. I think the reality is right now you're betting on people. At the end of the day, there's very few companies today that aren't forecasting 100, 200, 300% revenue growth. And so it really comes down to, can that management team execute, and do they have that killer instinct? Everyone in this industry has a human capital problem. Everybody needs more help. Everybody needs people around them. And so what you need is that ringleader who wakes up every day and says, I'm going to go get it, because it's a huge pie. And so generally speaking, the first and most important thing that we look at is kind of the management team and whether or not they have that killer instinct. I think this is the greatest tangible opportunity, certainly of this generation, if not of my lifetime. And we want CEOs that feel the same way and wake up every day to go get it.
Right, so when we're advising clients, we kind of look at it as a consumer packaged goods company. Most of the people that we talk to, the prognostication is that 80% of cannabis will be ingested as opposed to smoked. And so there's FDA compliance, which we do things of that sort, but kind of the same factors of who are the management, what's the management experience, who's on the board, and what's that composition, what's their governance, where they are located, and if they do have some track record and other kind of similar deal terms. But I think in this industry at the moment, it's probably much more difficult to pin valuations as it is in more traditional industries. Want to go on to one other topic, which is kind of looking into the future. Always hard to do. As we heard from the last panel, large tobacco is starting to look at it. Coca-Cola, there were rumors that they were going to make some investments. So large companies are getting into it. And so as you look into the future, what do you think in terms of tobacco, alcohol, big pharma coming in, and what you think the, kind of what the future looks like, and as part of that, if you can add in what you think the largest development or single development will be in the next 12 months. Start at the end.
I heard Altria was looking at the space, but hasn't been confirmed. I think generally speaking, brands are really where the action is going to be at the end of the day. That's how you relate to the consumer, and really this is a consumer packaged good. Obviously medical is its own animal, but what we think you're going to see this year, and you actually saw the kind of the first shots fired this week with GTI acquiring Bebo, we think that analysts, investors are going to look at the multi-state model and say, how are you really insulating yourself? How are you protecting your margin? How are you going to actually differentiate yourself from the liquor store down the street? And the answer is you have to own your shelf space. We think that guys like Curaleaf, who already own 70% of the SKUs on their shelves, they're thinking ahead and they're getting that. At the end of the day, and California is a perfect example, there's 600 open dispensaries today, and that number is probably going to go to 6,000. So what is the call to action to actually get people in your store? And it's going to have to be the experience and the product. And so thinking about 2019, we think there's going to be a lot more attention, resources, and capital that flow into giving somebody a call to action to go into that store. And whether that's either the customer experience at a high level or just simply having the best brands on the shelves, we think that the more astute investment community that's going to be looking at this at the latter half of this year, that's what they're going to be demanding.
Jason?
Well, you asked two questions, right?
I think I asked three, but we'll go with two.
One are these other, industry players looking at cannabis? I mean, clearly they are. I'm in a weird seat, so I see this stuff. The answer is yes, and I'm just not going to get into that anymore. What I think is going to happen in 2019, a number of things, right? So platforms will get bigger, right? Because these guys have access to capital and they want to just make their platform bigger. And no one's really caring about P&L today as much as actually making their platform as big as possible. So you'll see a lot of M&A, roll-up, et cetera, but also you'll see a distress cycle. Maybe not in the whole industry, but like there'll be a partial distress cycle where there are so many companies that actually got funded and they built infrastructure, and now they have to support that infrastructure, and they can't support that infrastructure, and they need more money, and the CSE is not like a magic money tree, right? So like ultimately, that's where I like to troll. I like to find guys where I can help fix things, stabilize things, get in a good level, et cetera. So you'll see you'll see that both. You'll also see bigger companies coming in here and making bets, I'm sure.
Yeah, I mean, a couple of things. I think I agree exactly with what Jason and Sean has, and that's opportunity, right, too, when companies start to consolidate or be eliminated, right? It's definitely going to be, I think, some element of survival of the fittest, which again comes back to, having good governance, having good oversight, having a good strategy, and ultimately a business model that's supported by, by a real strategy behind it. I think there's some interesting companies out there that are right now not maybe thinking about the spend on their marketing and distribution and what that's going to take. So that's going to be, they really are not, they're underspending and they're under planning for that. So for instance, there's a company out there right now called Flower Town that's really just doing a phenomenal job at building consumer confidence, educating the consumer, and then helping brands that are out there put together a strategy and implement it. So I think that's going to be key. I think there's some interesting things. Obviously, right now we have 10 states, where we have legal adult use. I think there's 5 other states that could happen in the near term. Big states like New York, Connecticut, New Jersey. That will have an impact, I think, in terms of just the overall acceptance, for the federal high-ups, if you will, Democrats being in the House. I think those things will help because ultimately there's a huge consumer base that isn't partaking in this and doesn't understand it, doesn't see the benefits, right? But I think when you have, more states where you have adult use being legalized, that'll definitely help. I think too, you mentioned, Barry, the transactions that happened last year. I mean, there was about 13 billion invested. I think 3 or 4 of those deals happened in the last quarter, right? And I found that the Tilray Novartis deal was a very interesting transaction, where you had the 4th largest healthcare company now being partnered with a fairly large cannabis deal, because I think, again, consumers don't understand the true benefits on the medical side either, and there's just huge opportunities there as that becomes, as more money comes in the healthcare side of things.
I think we consistently underestimate what's going to happen in the future. If we sat here a year ago today, I don't think any of us could have predicted the amount of growth and action we would have seen in 2018. I think 2019 is going to be very similar. Echo all the sentiments on the panel. There will be more massive corporates coming into the space. You'll see more legalization efforts. The 2020 campaigns are underway. Cannabis is a central issue there. I think the other element is the continued globalization of the industry, right? Both in Europe, starting to see movement in Asia, obviously South America. I think those countries can actually move a lot faster and quicker than even what we're doing here in the U.S., given we have this continued, issues between the federal and state level. So I think that's something else that we'll see a lot of news flow on in the coming months.
So Michael Rosenblum is one of my associates, and I wrote a paper on cannabis state-by-state regulations. We have a table in the back, and if you're interested in seeing what the different laws are in the different states, that's available to you. We've got just under 9 minutes left, and I said I would leave some time for questions. I can't see anybody, but there's a mic in the back. If you have a question, raise your hand. We have no questions. We have a question in the front here. Yes, sir.
Yes, the people that are the fund managers, what percentage of your portfolio, first of all, how large are your portfolios, and what percentage of your investments are public companies?
Can everybody hear that? So the question was for the fund managers, how large are your portfolios and what percentage is cannabis, correct?
What percentage is private versus public company?
Thank you.
We run about 225 million. Our portfolio is about 60-40 public to private in terms of assets. We actually own more private companies than we do public, but generally speaking, we try to maintain a pretty strong liquidity stance just given what we see in the market on both private and publicly.
We're partial to private companies. We do make public investments. I think 30% or so of our investments or portfolio is public.
We're all private.
Anybody else? Got a question right over here. And the mic is coming.
So I just had a question. So
Oh, yeah.
when the federal laws become deconflicted or becomes legal, how do you think that the products being able to go across state lines will affect the market, or if they will be able to go across state lines, if the local states will try to stop that?
Yeah, I think it won't be immediately open borders. I don't think that's going to happen. I think it'll take some time, specifically because the premise around this for all the states is to foster local economies and jobs and tax revenue. I think a lot of the East Coast states and whatever will be in big trouble if things just opened up immediately. So I think it'll come in phases. That's my view.
I would agree with that. I think, though, obviously it's going to be beneficial for the most part. I mean, you've got, states like Oregon with an oversupply, and then in California you've got undersupply in certain sectors. So I think, at least it should maybe equalize and allow some equilibrium.
I think that you're going to get a three-part response from the government this year. You're going to get banking reform, you're going to get some sort of state protections within the four corners of those states, and then I think ultimately this kind of gets wrapped up into criminal justice reform. And so those, to me, will take the better part of the next few years, well past the presidential election. However, I do think all three could potentially happen this year. And with that, they will not address interstate commerce and international commerce. I don't think that's a 2019 or 2020 initiative by the government. They're going to have their hands full expunging potentially 1.5 million people's criminal records. They're not thinking about interstate commerce just yet.
Question regarding the state of California with our new governor who is arguably cannabis friendly. I wonder what your thoughts are about California's growth with new political leadership in the governor's office. And as a follow-up question to the last question is, how much do you think of the growth strategy as a national strategy versus a state by state by state by state by state strategy?
I'm not sure who that's directed to. The second question, I think they're similar, right? You're seeing it from the multi-state operators, and Jason and Sean can speak more to that. But I think their national strategy is to go state by state by state. I mean, that's what's happening. From a brand perspective, there's potential channels to get national recognition and notoriety and awareness, but you still have to go state by state by state. And I think that's going to be the same for a while. And I don't remember what the first part of the question was.
I have to re-ask it.
Hi. We talk about North America, which is about 400 million people. You haven't talked about Europe, which is another billion and beyond. Would you talk about that?
I'm happy to talk about that. We just hired someone. He's actually in Paris today at Cannabis Europe. We think Europe's going to be absolutely massive. We think that in essence, they're going to move quicker than North America did. If you really think about how long it took Canada, Canada first passed the medical marijuana laws in 2004. So it took about 14 years to go from medical to rec. We think that cycle is going to be much, much quicker in Europe. What you're starting to see in Europe is CBD is pretty prolific. We think that's going to continue. And then as you saw in the UK, which is effectively a compassionate use case turned into an entire country going medical, the UK sort of sets the barometer for much of sort of not the non-US Western world. And so what we're seeing out of Europe and Africa is everybody's kind of queuing in on what's going on in Western Europe. And so we're very bullish. We think that there's going to be limited licenses in pretty much every European market for the near term. Those are good businesses. If there's only 13 licenses in Germany and the price of a gram is 13 euros, that's a pretty good market. So we're super excited about Europe this year. We're super excited about the emergence of what you also have to remember is it takes a lot for an entrepreneur in a legal state or was the country that was illegal 6 months ago to raise their hand and say, I'm going to get into cannabis. And so as that stigma goes away, you see better and better quality management teams, which we think this is the year for Europe, India, Asia, Africa to all sort of at least start their programs. And almost always these programs start with medical. And now you have 14 medical countries in Europe. And so it's inevitable one of those 14 will go rec, but if we're just looking at the medical market, Europe is going to be absolutely massive, and you're going to see real investable opportunities this year.
We have a question in the back.
Hey, so we've heard a lot of conversation about equity investment opportunities. I'd be interested to hear you speak through a debt lens about where the tightest cash flow bottlenecks are, and what interests you maybe through that perspective.
I would just say the convertible debt is interesting right now because you do want to give yourself a floor in some instances. Like Jason talked to, we think there's going to be a ton of distressed deals that get done in sort of the next 12 to 24 months. And so if you're doing at least creating a floor for yourself where theoretically you can go in and take some assets and get your cash out, that's not a bad way to be thinking about it. I think the reality is we're all trying to underwrite pretty big returns, and so there's not a lot of debt instruments as a standalone that kind of correspond to the equity underwriting that we're doing. But as we move on and more distressed and more failures happen, but there are good hard assets, loaning to own is not the worst strategy here.
Let me follow up question that I should have asked before is, and when you're looking at a company, what's a red flag for you to not invest?
Corporate governance, management selling shares, management acting irrational. I think all of those things are massive red flags. Dumping stock in the market. There's going to be several textbooks written about some of the things that have gone on in the last 12 months in Canada.
But I think also, just more from an empirical stage into the question on debt, you have to be able to service your cash flows, right, if you're going to repay a debt instrument. So I think the lenders that I'm working with are all over, the forecast, the cash flow forecasting, the science behind that, and kind of the details. Just don't give me a 13-week forecast and just show me the top line and we'll kind of make a swag at it. You have to get into the details. You have to understand what we've done every quarter this year and how that translates going forward, and have real measurement and reporting of that.
All right, we're down to the last 30 seconds. Panel, any last thoughts?
I think something no one's really talking about yet that's going to be a big theme this year is social equity. I think a big part of what's going to push this through at the federal level is criminal justice reform, and that's going to constitute a lot of new social equity programs. So I would say to kind of anyone looking at the industry, be aware of what's happening. I think the government sees a path forward, which is probably via criminal justice reform, and that's going to have big implications for a lot of the multi-state operators and a lot of the limited license markets.
Jason? Good.
I just think there's going to be a huge need for banking solutions. There already is. There's a couple of companies like Hyper and Dema that really help, but I just have clients right now that they just got banked with a regional bank here, and now they've shut their doors on new cannabis plant touching businesses. So that's a real problem. So I think we're going to need some innovation around banking solutions.
Curran, last thoughts?
No, I mean, if there's, investors in the audience, just be, mindful and be diligent. I think, there's a lot of hype and a lot of excitement around this industry, and I think it's deserved, but, just be intelligent when, allocating your dollars.
On behalf of the panel, we'd like to thank ArcView, and we'd like to thank you. Have a good one.